Hi, welcome to this month's Market Talk. This is Ben Hager. This is a new concept that Jeff and I have as our monthly video calls are broadening out to cover topics around financial and life planning, as well as broader investment themes. We wanted to make sure we're staying in front of you and getting relevant, timely information in your hands on a monthly basis. So these are meant to be short, brief updates, really around what is on Jeff and I's mind at the moment, impacting investment markets. So here we go. Inflation and interest rates are top of mind for Jeff and I. Really, those two go hand in hand. We're keeping an eye on conversations around inflation, policies coming out of the new administration that may or may not impact inflation, and more importantly, how that's really going to impact interest rates. Reason we're worried about interest rates is obviously that can have an impact on the safe haven part of your portfolio. In other words, bonds, that side of the portfolio. We want to understand how interest rates may or may not be impacting that piece, but also how that's going to impact the equity or stock side of the portfolio. With some valuations that are high on some companies, more strong growth type businesses, we've seen them move around quite a bit to start the year. And it's been based on interest rates. And when we move to the higher end of the range, those stocks don't enjoy that. They kind of get stressed. When they move to the low end of the range, we see nice recoveries, which is really what we've gone through over the last couple of weeks here. Another item is earnings. Earnings are very important. Earnings are the fuel that can really support and justify these valuations and continue to move these stock prices up from here. So, as we move through earnings season, it's important to hear from these companies and understand, are they meeting investor expectations? Are they exceeding investor expectations? And is that earnings growth starting to broaden out beyond just the technology universe that's really dominated a lot of the earnings growth over the last couple of years? In hand with that, strength of the consumer. Obviously, the consumer is very important to our economy. It represents about 70% of consumption in our economy. So that's a big piece, not only of our economy, but also for these businesses, whether they're selling services or goods. It's the consumers that are driving those businesses forward. So, strength of the consumer through their confidence and continued strong job markets are really going to be an important topic for Jeff and I to keep our eye on as we move forward through 2025. I think it's important to just acknowledge the fact that we've just gone through two really nice years. Naturally, the third year gets a little bit tougher. Does not mean it's a negative. That's for sure. I want to make sure we identify that. We've worked with some of our partners, including Strategas, that helps us collect a lot of data and look at past history and learn from it. And when we've gone through some significant time periods like this, like the 90s, late 90s, the third year doesn't have to be a bad year, but it tends to be a choppy sideways year, ultimately ending positive on average, but it comes with more of these sideways movements. At points through the year, you could see some drops, et cetera. And so, more than anything, I think it's just important to keep that kind of stuff in mind as we move through this third year, that it can get a little bit tougher compared to the two prior years. Um, I think it's also important here to touch on something real quick around stretched optimism. Coming into this year, investors were very optimistic around a lot of topics, but the one thing that does start to set us up a little bit for some negative surprises. There's a saying in our industry that markets climb a wall of worry. At the point that we feel like everything is perfect, it's hard to continue to climb that wall. The worries have been dissipated, right? But as, as we move forward, that is going to be a big thing, is how do we continue to monitor for those negative surprises when investors are so optimistic. And we've started to pull some of that optimism down, which is really helpful. And that gives more comfort to Jeff and I. And the main reason we focus on that is for the last point here, which is bull markets tend to not die from valuations, but rather policy errors. And those policy errors could come from a multitude of areas in the government. It could be around tax policy, which is up in the air at the moment and being discussed. Could be around tariff policy, which is widely being discussed and talked about in the media, but also on the interest rate side. What does our Fed do? Do they continue to pause? Do they cut, et cetera? And again, a lot of expectations around that. So as those policies continue to be discussed and we learn more about those, watching for any negative surprises with high expectations from investors is going to be top of mind as we move throughout 2025. So with that, hope you have a good rest of the month, and we'll be back to talk to you again next month. Take care.